Hello, you're very welcome to this series of pre-scene analysis videos where we will be analysing the May 2018 Strategic Case Study Pre-Scene document. This pre-scene, I think, is a really interesting one. It's based on a very topical industry, that of media streaming, which I'm sure many of you are aware of, and many of you are, in fact, subscribers as well. You think of famous streaming companies like Netflix, Amazon Prime, etc. And this particular pre-scene is based on Couchweb, which is a fictional company. So over the next 5 videos, I'll be analysing each section of the May 2018 pre-scene document, talking about the most important points and the implications of the information included in the document and relating it to issues that could be coming up on exam day. So, jumping into the document itself, we start with this introductory section where you're told that you're the senior manager in the finance function at Couchweb. So you're moving up in the world and you're going to be reporting directly to the board and advising on special projects and strategic matters. So we're told that Couchweb is based in the fictional country of Mayland, where the currency is the M dollar. And companies preparing their financial statements in Mayland are expected to do so in accordance with international financial reporting standards. Okay, so after this brief introductory section, we can say a couple of things, starting with your role as a senior manager. At the strategic level, your focus is going to be long-term in nature. For those of you who have come up through the CIMA levels and have sat the operational case study and the management case study, you'll know that for the operational case study, your focus is on the short term, so under a year, whereas at the management level, you're looking more at the medium term, 1 to 3 years. The long-term focus then of the company at strategic level will deal with strategic options that impact the company in the long term, so 3 to 5 years and beyond. So the importance of the decisions taken here have substantial impact for the long-term sustainability of the business. The fact that you're advising those at the highest level of the company, i.e. the directors on the board, the CFO, the CEO, etc., means that you will be trying to influence the decisions that they take, and you'll be trying to guide them in certain strategic directions. So your people and leadership skills are really going to come to the fore at the strategic level, whereas they were only a very, very minor part of the total marks assigned at the operational level, for example. At the strategic level, people and leadership skills are each assigned 25% of the total marks. Technical skills and business skills also get that same weighting. So those soft skills are going to be very important, and you'll need to think of the way that you address the people you're dealing with on exam day and how you can influence them successfully. So, as I said, your audience are senior leaders of the company, in other words, the board of directors, the CFO, the CEO, etc. And at the strategic level especially, you'll really be expected to understand the full context within which your business operates. In other words, you'll be expected to consider the wider economic environment, your competitors. You'll be expected to take into account the needs of other stakeholders outside of the business, such as regulators, the wider community, customers, etc. So all of your recommendations should take into account the key stakeholders that the business is interacting with. You think of Mendelow's matrix as a very effective model to employ when thinking of stakeholders, the level of interest they have, the level of power they have, and depending on their level of interest and level of power, you would treat each stakeholder differently. Relating then the strategic case study back to your objective studies of E3, P3 and F3, the areas of study that are particularly important and tend to come up again and again coming from those theoretical studies would be for E3, recommendation of strategic options. It's going to be very important at this level, not only to weigh up the pros and cons of certain strategic approaches, but to give a final recommendation. So to conclude each of your answers with a recommendation. You're not expected to sit on the fence here. You're expected to come down on the side of one option or another on the balance of the evidence you've presented. What is the final recommendation that you actually make? So keep that in mind. P3, risk, and certainly for the strategic case study, a more detailed consideration of risk is important. And for this case study, there's a risk register that we'll talk about later on, which is a little bit flawed in my view. We'll go into detail on that when we come to it. And for F3, it's about securing adequate sources of funding for the long-term strategic plays that you're going to be making, and determining the right financial strategy for the company. So in the case of Couchweb, when we look at the financial statements, we'll see very clearly that they're a company that is carrying a high level of debt. So they can't really take on more long-term loans. So what are they going to do if they need to make a big investment? They need to look at equity perhaps, or some other form of financing. The fact that Couchweb operates in mainland and has this currency of dollars, we're later going to see that they're a global company, so they're likely to be exposed to other currencies as well, and that brings up the topic of exchange rate risk, which was a part of your F3 studies. And actually we'll see that there is no mention of hedging at any point during this pre-scene. So I wonder instantly whether this is a weakness for this company and whether they should be employing some hedging strategies with financial instruments to account for that exchange rate risk. So let's see the company background. Couchweb is a media streaming company, and with that, their subscribers are able to access the content that they make available on their website over the internet at any time and from anywhere. So they're not putting out live broadcasts. Instead, they have a library of content that the user can access whenever they want. So convenience is the name of the game here. And that in the past, traditional broadcasters of programs, they didn't have that advantage. But actually, what we're seeing now is that traditional broadcasters and satellite television, they're starting to employ some of the tricks that a company like Couchweb employs. They're making it possible, for example, to pause live TV and to record live TV so that you can go back and watch it later. But it's a little bit more of an active process than the advantage that Couchweb offers, where they have a library of recorded content and you don't have to do anything. You just go in and use it whenever you want. So in exchange for this convenience and this library of content, you pay a small monthly fee. A company like Netflix would typically charge maybe $10 per month, which is much lower than satellite providers are charging. So they certainly offer value in that respect. So the hardware that's used to watch these, to access this media library comes in the following forms: smart televisions, laptops, tablets, and smartphones. They all share the same necessity to have a strong internet connection to be able to access this streamed content. So it's not Couchweb that is actually providing the hardware, installing it. They're simply making use of hardware that is widely available out there. In that way, they keep their operating costs lower than a satellite television provider, for example, that needs to provide hardware in the form of a satellite dish, and that brings up their operating costs. So Couchweb's content, we're told, is exclusively entertainment, and it's primarily TV programs and movies. And that is really all that is referred to in this pre-scene. There's no mention of any other type of content, although, a company like Netflix, for example, also provides a bank of documentaries. For example, there's no mention of other types of programming like reality TV or live sports, for example. They're types of programs that are provided by traditional television broadcasters and satellite television providers, and maybe it's something that Couchweb wants to start looking at. So one of the drawbacks with this type of service is that you can't actually download the material to watch offline, so you need a reliable internet connection, and that was certainly a problem a number of years ago because fast, reliable internet connections were not widely available. And in fact, you would imagine as well that for a company like Couchweb, it's going to be an obstacle in certain markets where fast internet connections are not widely available, so they'll be limited in that way. But as fast internet connection becomes more widely available, that will certainly play to Couchweb's strengths. So the danger with downloading the material, of course, is that it can be pirated and widely shared for free. And that is something that a lot of media and content companies are having to combat in recent times. So the site that Couchweb has tracks the content being watched by every subscriber, and in that way they can actually build up a profile of which programs and movies are proving to be successful, and they can also build up an accurate picture of what each individual user is drawn to. In that way, they can make recommendations based on the algorithms that they have developed to classify subscribers' viewing histories. And as it says there, they can make recommendations based on the picture they build up of each of their subscribers. But there's an immediate tension coming to the fore here, and it's something that's getting more and more publicity: the sensitivity of the data that we hand over to companies like Couchweb. Of course, Facebook is in the news a lot recently over perceived breaches of data confidentiality, and Mark Zuckerberg, the CEO of Facebook, in fact, has been hauled up in front of politicians in the United States to explain himself and the actions of his company, and it's making, I would say, other internet giants very uncomfortable as well. So they might be open to more regulation in the future and open to fines as well. And that's something we'll see towards the end of this pre-scene as we look at the articles. So they need to be careful that the data is safely guarded. So there's that tension between the privacy of the data versus the convenience of being able to tailor content according to each individual subscriber's preferences. Of course, we're talking about algorithms playing a very central role for this technology company, and we see the increasing importance of research and development and also intellectual property, and the protection of that intellectual property is going to be critical to the success of a company like Couchweb. Couchweb was founded 20 years ago by Chet Nolan, Jen Kramer and Joe Ying, and these are three old university friends. They're still at the company, and Chet, we're told, he's the CEO of the company. He has an IT background, did a computer science degree. And Jen has a legal background, which is going to be very useful in protecting that intellectual property. And Joe then has a marketing background and did an MBA, we'll be told later on. So they're quite complementary skills for an IT commercial entity. So it's very likely as well the fact that the three founders of the company are still at the company, and we would assume, although it's not mentioned explicitly in this pre-scene, that these three founders still have a big stake in terms of the ownership of the company. And if that is the case, then that would obviously grant them a lot of power, but also you could be sure that they would act in the best interests of all shareholders. In other words, there's less likely to be an agency problem where those who are given the responsibility of running the company on a day-to-day basis could act in their own interests at the expense of the owners of the business, in other words, the shareholders. That's the agency problem, but it's less likely to be the case, of course, because if the executives running the company on a day-to-day basis also have a big shareholding, then they're obviously going to want to act in the best interests of those with a shareholding. So at first, what Couchweb did, and this is actually what Netflix did when they started as well, so there are very, very close associations with the real-life company Netflix. So Couchweb rented out DVDs by post to customers, and that seems very old-fashioned indeed. And what happened was the customers would watch the DVDs and then post them back after watching them. But of course, with this service, operating costs were very high due to postage costs being high and the need to dispatch and return the return of the DVDs. So they got a little bit fed up with that, and the directors were keen to exploit the internet as a way to transmit the content that they wanted to get out there. And the biggest obstacle, which I mentioned before, was the lack of fast and reliable internet connections. And that those connections have only been improving to the extent that they can support the current model of streaming content into subscribers' homes in the last 10 years. So factor conditions are important. These would vary country to country. The internet infrastructure, the speed of internet connections is going to vary from market to market. And because this company, as we were told in the next paragraph, is present in over 100 countries, the internet connection, the speed is going to vary between each of those countries, and that could be an obstacle to the effectiveness of Couchweb's offer. So you think of the pest analysis, the technology has utterly changed the market for media content, and the improving internet connections have made it possible for a business like Couchweb to exist. So the growth of the company has come through organic means of growth, so winning more and more market share with their current offers, and also through acquisition of other media companies, which is a more aggressive way of growing. And it may well come up on exam day that this company is looking to acquire some other company, and it may be important to put a valuation on the acquisition target. And for IT companies, they're going to be looking at other IT companies perhaps where the physical assets of the company are going to be altogether less important than the intangible assets, the intellectual property, the software, the patents, etc. that the company would have. So the valuation method you would use would be unlikely to opt for an asset-based valuation that would only take into account current physical assets, for example, because that would undervalue the acquisition target. So we're told that they stream content to more than 100 countries in over 20 languages. So Couchweb's business model differs from traditional television broadcasters. With traditional broadcasters, they broadcast using terrestrial transmitters that send signals to aerials, so there's hardware involved, which adds to the costs, of course. And of course, it adds to the headaches for both the company, the television broadcaster, and the headache on the part of the customer having to ensure that they have a television aerial, etc. Whereas with Couchweb, everyone has a device like a smartphone, etc. nowadays, and it's all the barriers to sending out the media content for a company like Couchweb are much lower than for a traditional television broadcaster, for example. So with the traditional television broadcasters, the content that they sent out could only be viewed at the time of transmission. And as a means of generating revenues, rather than generating revenues from the viewers, they generate revenues through advertising. So the advertising slots that pop up between during the breaks for transmissions in programs, that is what primarily generates revenues for these companies. And with satellite television, then another means of transmitting content. Again, there is a hardware element because the viewer needs a satellite dish, so that adds cost as well. So subscribers to satellite channels have a receiver box that's programmed to record broadcasts, allowing subscribers to watch them later. And that's a more recent development. So that actually starts to encroach in Couchweb's area of advantage at the moment. And with satellite subscriptions, we're told that they can be quite expensive because the operating costs of the satellite companies are quite high. And what Couchweb has done essentially, though, is disrupt this traditional marketplace. They've disrupted the traditional television broadcasters and the satellite television providers. And with disruptive technology, it means that there is a groundbreaking product or service being provided that changes the industry. And it's the fast and reliable internet connections of the last 10 or so years that has allowed a company like Couchweb to disrupt the traditional market for viewing of programs. So with disruptive technology, there is higher risk taken on because it's a brand new product. People aren't used to it. So it's harder to sell something that is completely new. But if you take on high risk, the positive side, the flip side is that you could potentially have very high rewards. And that seems to be the case for Couchweb, which is now one of the largest media companies in the world, we're told in a little while. So, as opposed to the traditional broadcasters and satellite companies, Couchweb relies on subscribers accessing content over the internet. So that internet capability is needed, whereas for the traditional broadcasters, it's not. And all content is placed on the website. Subscriptions are kept at a very low price to attract high volumes of subscribers. So I said about $10, for example, for a Netflix subscription per month. And with the new technology, of course, technology can keep costs down or at the same level, but these companies can reach a wider audience, a worldwide audience, without having to build a huge physical infrastructure or to take on huge costs to install hardware on the behalf of the viewer, for example, as satellite companies would do. So they can take advantage of faster internet connections and the fact that people already have the hardware required to view the content that they have, and that is what Couchweb is doing. So the fact that their prices are low to attract a high volume of subscribers makes us think of Porter's generic strategies. And it would position Couchweb as a sort of cost leader because they have this broad they have a wide audience, a broad focus, and the emphasis would likely be on keeping costs down. And with technology, as I mentioned before, you can achieve those cost advantages and keep your overheads quite low. So interestingly, in the last part of this section, we're told that the founders of the company have always agreed that content is what sells subscriptions. So content is king. Although all the talk to this point has been about the technology behind the Couchweb offer, it's actually quite old-fashioned. The key selling point for this business, the content, the quality of the programs that they have needs to be high, and it's that quality content that differentiates Couchweb from its competitors, for example. And we all know that. A lot of us would have been drawn to services like Netflix because we wanted to see 2 or 3 very high quality shows in particular, and we were willing to part with $10 a month or whatever it is to access those few shows. In the mission statement, then, we're told that the mission of Couchweb is always entertaining. So this is the organization's basic function in society. And certainly given the huge bank of movies and television programs that they have, it's unrealistic that any one subscriber could get through all of that even in a lifetime. So certainly I think it's It's an accurate claim to say that they're always entertaining because they've such a deep library of content. And the vision of the company, remember, is more aspirational, an idea of what it could be in the future. The vision is to become the best global entertainment service in the world. So that's quite ambitious, certainly, to license the best entertainment content available for streaming to the customers, to provide to provide movie and television production studios with access to audiences, and to encourage innovation and creativity in the production of programs in movies. So what we're lacking here, though, I would say, is our specific strategic goals to see the company through over the next year or two. So they're kind of low on detail. It's a little bit vague. So they're talking about a goal that's kind of far off in the future, but they're not really putting it into translating into specific goals. So certainly they're ambitious, and a key consideration, as well as looking at how profitable any strategic proposals might be, it's useful to think of Tucker's 5 questions before going for one particular strategic option. First of all, is it profitable? Secondly, is it legal? Third, is it ethical? Fourth, is it sustainable? And finally, is it fair to stakeholders? And those last considerations in particular would be important at the strategic level, where you're meant to take a wider view of the environment within which your company operates. And ideally, your company should look to be an ethical company and look to be a good corporate citizen. So with a company like Couchweb, they can take more risks with their programming due to the costs that they have being spread out over a huge number of shows, and niche shows would even still generate high overall views due to the huge international presence of Couchweb. So even shows that are relatively unsuccessful for Couchweb are still going to have hundreds of thousands of views and even millions of views. So there's justification to take risks with their programming, and and companies like Netflix have become renowned for providing interesting programming that perhaps traditional broadcasters wouldn't take on. So traditional broadcasters, with their higher costs and their need especially to satisfy advertisers, are less likely to go all in on a risky program because it could have huge financial implications for their organization. But with Netflix and companies like Couchweb, because they are so geographically diversified and reach so many millions of users, and they aren't having to bow to the pressures from advertisers, they can take a little bit more in the way of risks with innovative programming. So the industry background tells us that the media streaming industry is a global business with a relatively small number of major companies. So there's an oligopoly of sorts in operation. With an oligopoly, what happens is the competitors tend to keep a very close eye on the moves of their rivals, but generally they're trying not to rock the boat too much. They're trying not to compete too much in price. They keep those pretty stable, because why would they want to do that? Because they're generally enjoying a pretty good thing. And there's little need to establish a physical infrastructure, which I've talked about a little bit already, in the same way that the satellite providers and traditional broadcasters would have to do. With the power of the internet, this company has global reach. They have a website, that's all, and they can reach a wide audience without having to make huge capital investments in physical assets. So we'll see on the balance sheet that there is certainly low property, plant and equipment in the non-current assets section compared to intangible assets. And the studios were told that produce movies and television programs cater for international audiences, with content being dubbed or subtitled into a number of languages. So that is obviously going to mean more cost in adapting to other markets, foreign markets, and we'll see that when we look at the financial statements, that the operating profit margins are a little bit lower for overseas markets, and certainly the dubbing and subtitling of shows that already exist would account for those higher costs, for example. And we're told that there is a constant threat of competitors offering their own innovations. So it's necessary to spend heavily on patents and on research and development. So high intangibles is what we see on the balance sheet. So that need to spend heavily on intangibles and research and development, that counters the advantage of having to invest very little in physical infrastructure. And the most immediate competitors, we're told, are Home Video and Movie Master, although neither has the products that Couchweb has. They're not as technically advanced as Couchweb. So Couchweb, it seems, has a larger subscriber base, and as a result, it can afford to spend more on getting quality content in. And that's a virtuous circle of sorts. The fact that Couchweb has a larger subscriber base means that they have more to spend on acquiring quality content and making quality content, and because they have that quality content, they then attract more subscribers, which means they have more to spend. So you can see that there's a virtuous circle, and that'll be hard for rivals like Home Video and Movie Master to break. So often you find as well in high-tech industries that there is a significant first mover advantage. They can acquire high market share. You think of Google, for example, in search, or Microsoft with its Office package. They were amongst the very first movers in those spaces, and they quickly became the standard in those markets. And it seems Couchweb has done something similar, and as a result, they have achieved significant market share. So already we can reflect perhaps on Porter's 5 forces, which comes from your E3 studies. You think about the competitive rivalry here. I've mentioned that there's an oligopoly of sorts in operation, so rivalry would likely be low to medium. And with buyers, you think of the end users of this service, Couchweb service, so subscribers. You would say maybe it's medium. There are low barriers to exit, which we'll talk about in a while, given the fact that there's no cancellation charge for breaking your contract with Couchweb, for example. So you can move to one of the rivals, Home Video or Movie Master, without being penalized. So low switching costs in place there. But of course, Couchweb, it seems, is the market leader. They have very high quality content, so that gives them force and gives them some power over the buyers of their content. Threat of new entrants is probably low because there's strong brand recognition at this stage for big global companies like Couchweb. Substitutes in the form of traditional broadcasters and satellite providers, I would say, is medium. Certainly those traditional operations still have programming that is very attractive to their viewers, such as live sports, for example, reality television programs, etc. A lot of companies like Couchweb have not really followed traditional providers into those areas that are still very popular. And supplier power, so these would be the production studios that make the movies and make the programs. They would have medium power. As companies like Couchweb become bigger and bigger, they wield more power over the production studios, certainly.